In this segment, I will introduce the topic of bonds. Bonds are basically an IOU. If you think of them like the IOU or something that you would loan somebody else or that borrow money from somebody else, bonds are the same way. It's just a corporation borrowing money from you. If you borrow money from somebody, there's three things you want to know. How much are they borrowing, or are you borrowing? In a bond, that's called the par value. It's the amount of the borrowing, and it's the amount that's owed at the maturity of the bond when it has to get paid back. Normally, par values are $1,000. What else do you want to know about a bond? Well, you want to know how much you're borrowing. You want to know how much interest you have to pay. Interest is the cost of borrowing money. For a bond, we call that the coupon rate. So it'll be an interest rate, and the payment that gets made is whatever that coupon rate is, say 10% of the par value. So if the par value is $1,000 and your coupon rate's 10%, the bond will pay $100 a year. Or typically a bond pays interest twice a year, semi-annually. So it'll pay that $100 in two pieces. $50 twice a year gives you $100, which is the 10% of the $1,000 bond. And finally, the third thing you want to know when you borrow money is, when do you pay it back? Those are the three things that determine the price of a bond. The par value, the amount of the loan, the coupon rate, the interest that gets paid, and the maturity, when that bond has to get paid back. Now, an interesting thing to note is when you are talking about par value, if you go look up bond prices on the internet, they're normally shown as an integer like 125, as I show here in the slide. Those are 125% of the par value, which in this case would mean $1,250 is what the bond would be priced at. We'll talk about that a little later in terms of why bonds are priced higher or lower than the par value. Now, bonds have a certain feature, or may have a certain feature, in that they may be callable. Callable means that the person can pay back the bond early if they want, or they can redeem the bond. Why would you do that? Well, if interest rates fall like they have been in early 2020, interest rates are falling, well, I can borrow the money at a cheaper rate. So I'll pay back the bonds that have high rates and borrow money at lower rates. Bonds can be considered to have a claim on assets. That's important. What that means is if the company defaults, the bondholders are the ones that get paid back first before the stockholders receive anything. Now, there's several types of bonds. There's corporate bonds. Corporate bonds come in really two basic flavors. Debentures. Debenture is just a promise to pay back, an IOU. There's no collateral, nothing. A secured bond is one that has collateral. You can think of, say, Exxon might sell a secured bond, which is secured by maybe an oil tanker. So if they go into default, the bondholders can have claim to the oil tanker and therefore get paid back. Why would a company sell secured bonds? Well, they would sell secured bonds because they're less risky and therefore they will pay less interest. Bondholders will require less interest. They require a smaller rate of return because the bond is safer because it's secured. Government bonds come in two flavors. U.S. government bonds, U.S. Treasury bonds. These are bonds that have a maturity date greater than 2 years. Most popular one you'll hear about is the 10-year Treasury bond. But we look at the 10-year and the 30-year bonds as well. Municipal bonds are bonds that are issued by state and local governments. They come in two flavors. One is a general obligation bond. That just means that they promise to pay you back. So if Bridgewater wants to build a library, they might issue a general obligation bond. They won't have the money sitting around, so they go borrow it. The way they pay it back is through taxes. So the interest that gets paid on a municipal bond is paid by taxes. There's also revenue bonds. Sometimes the state or municipality might build something that generates revenue. A great example is the Parkway. Parkway has tolls on it. Those tolls were used to generate revenue to pay back the bonds. Interesting side fact is the Parkway bonds have all been paid back, and yet we still have the tolls. Why? Well, state loves to get money. We have Euro bonds. Those are bonds that are issued in dollar-denominated bonds, but might be issued by another country. Sovereign bonds, sovereign debt. Sovereign debt is basically government debt. Right? If Norway issues bonds or Sweden issues bonds, we call that sovereign debt. Convertible bonds are bonds which can be converted at the owner's request, typically into common stock. And then finally, we have mortgage-backed bonds. These were the famous things that caused such havoc in 2008. Now, bonds have risk, and there are companies that try to rate the risk of bonds. You'll see Standard & Poor's, famous for the S&P 500, but companies like Moody's and Fitch also rate companies. They all have a little bit of different scale, but it all looks pretty much like it looks in this slide. The best rated, the least risky bonds are AAA and AA, A, triple B, double B, B, all the way down to D, which means default. Now, there's an important, significant mark between these, and that is bonds that are BB and below are considered junk bonds. They are considered very high risk. Bonds triple B and above are considered to be investment grade bonds. Now, it's important to know that BB and below are junk bonds because they are also called in the industry high yield bonds. Makes them sound real good, right? I'm going to get a high yield. I'm going to get a lot of money out of these bonds. Why are they paying a lot of money? Because they're very risky. Why would somebody hold a risky bond? Well, they pay high interest. So be very careful when you hear somebody call, oh, high yield, I'm getting high yield. Yes, but you are also taking on high risk, and they're called junk bonds. Many organizations are prohibited by law from investing in junk bonds. Pension funds, for example, are not allowed to invest in junk bonds. All right, next we will look at how we evaluate and price out bonds.